A stock just lost 16% of its value in a single trading session, and the headline reason most people will read is completely incomplete. PureCycle Technologies, ticker PCT, shed 16.1% on heavy volume in June 2026, and if your first instinct was either buy the dip or the company is collapsing, both of those reactions are wrong without context. The real question is, what does a move like this reveal about the structural risk embedded in every development stage industrial company? And why do retail investors keep getting blindsided by exactly this pattern? Let's be precise about what drove this move, because vague explanations cost investors real money. PureCycle Technologies is a development stage company commercializing a polypropylene recycling technology originally licensed from Procter & Gamble. They are not yet a scaled, profitable business. That context is not incidental. It is the entire framework through which a 16% single-day drop makes complete sense. Development stage industrials like PCT sit at a particularly dangerous intersection. They require enormous capital expenditures to build physical infrastructure. They generate little to no operating revenue to offset that burn. And they fund operations through repeated equity raises. Every time PCT comes back to the capital markets, whether through a secondary offering, an ATM facility, or convertible debt, existing shareholders absorb dilution. That dilution is not a surprise. It is the business model at this stage. What triggers a violent single-session sell-off is typically one of three things: an unexpected operational setback at their Ironton, Ohio facility, a financing announcement that signals the company's cash runway is shorter than the market believed, or a broader institutional rebalancing away from speculative small-cap names when risk appetite contracts. In PCT's case, in June 2026, the catalyst lands squarely in the category that should concern any investor who bought this stock on the recycling macro thesis, without doing the balance sheet work. The actionable insight here is straightforward. Before you enter any development stage industrial position, your first question should never be about the technology. Your first question should be, how many months of cash does this company have, and what happens to my shares when they inevitably return to the market for more? For PCT, that answer has historically been uncomfortable. Here is where analysis requires intellectual honesty rather than reflexive optimism or pessimism. A 16% move on heavy volume is not random noise. It is a message from the aggregate judgment of buyers and sellers who collectively have access to the same public information you do, and some who have access to far more. Respecting that signal does not mean accepting it as final truth. It means taking it seriously as data. Let's look at PCT's situation objectively as of mid-2026. The Ironton facility has faced a documented history of operational challenges, startup delays, and throughput targets that have shifted multiple times. That track record is not a secret. It is in every quarterly filing. What the market has been doing for the last several years is repricing the probability distribution around when and at what cost PCT reaches true commercial scale. Every operational miss tightens that distribution in the wrong direction. Is the 16% drop justified? The honest answer depends entirely on what the specific catalyst was, and whether it changes the long-term throughput or unit economics thesis in a structural way, versus simply delaying a timeline. If this is a financing announcement at a dilutive price, that is painful but survivable. If this reflects a fundamental constraint in the recycling process at commercial volumes, that is a different category of risk entirely. What we can say with confidence is this: PCT's market capitalization, even after this drop, still implies a significant premium to any near-term cash flow reality. The stock trades on optionality, on the belief that the technology works at scale, and that polypropylene recycling becomes a multi-billion-dollar market. That optionality has real value. It also means that any single data point which reduces confidence in that future gets amplified dramatically in the share price. This is not broken. It is exactly how speculative equity valuation works. For investors sitting on a position, the question to ask yourself is not whether PCT is down 16% today, but whether the information revealed today changes your conviction in the 5-year thesis. If it does not, volatility is the price you agreed to pay when you entered. If it does change that conviction, then the size of today's loss is irrelevant to whether you should exit. This is where the video pays off for everyone who is early in their investing journey, because PCT is not an anomaly, it is a template. The pattern we see here, compelling technology thesis, massive addressable market, heavy capital requirements, repeated dilution, violent price swings on news flow, repeats across clean tech, biotech, and advanced materials with statistical regularity. Here's the most important structural fact beginners miss about companies like PCT. When a development stage industrial company is burning cash and not yet generating meaningful revenue, every single piece of news gets filtered through one question in the market's mind. Does this change the probability that they reach self-sustaining operations before they run out of money? That is it. Technology elegance does not matter. TAM slides do not matter. The CEO's vision does not matter. The math on survival timeline dominates everything else until the company crosses into positive operating cash flow. This creates what experienced investors call binary adjacent risk. PCT is not a binary outcome, the way a phase 3 drug trial is, but it rhymes with that structure. When you own it, you are implicitly betting on a sequence of events. The technology works at scale, the capex comes in close to projections, the offtake agreements hold, the market for recycled polypropylene develops as modeled, and the company does not dilute shareholders into oblivion in the meantime. Every one of those conditions needs to hold. A single miss on any one of them, and the probability math changes fast. The beginner lesson is not to avoid companies like PCT. Some of the greatest wealth creation in public markets comes from identifying development stage companies that actually execute and reach scale. The lesson is position sizing. If the entire investment thesis hinges on a sequence of uncertain future events, your position size should reflect that uncertainty, not your enthusiasm for the underlying technology. A 16% single-day drop should never create a margin call, a sleepless night, or a panic sell if you size the position correctly from the start. That is not emotional advice. That is portfolio construction math. And frankly, this is not financial advice. It is just how risk-adjusted portfolio thinking works for anyone managing real capital seriously. The investors who consistently survive and compound through volatile, small cap names are not the ones with better stock-picking instincts. They are the ones who never let a single position represent a bet-the-portfolio conviction trade on a company that has not yet proven it can operate profitably at commercial scale. We open this video with a simple question. Is the 16% drop in PCT justified, and what should you learn from it? The answer is that justified is the wrong frame. The move is logical, given the structural risk profile of any development stage industrial company operating on borrowed capital and optionality pricing. The real question is whether your position size was sized for that reality from day one. Next week, we are looking at the broader clean tech basket and which names in that space actually have the unit economics to survive. Subscribe so you catch that analysis when it drops.